Good evening. My name is Scott Lurie with F Street. We're going to get started here in 1 minute. I'm grateful for each of you to be here this evening to go over our opportunity pipeline at F Street. I'm very excited to share a little bit about our past, as well as share some of our future and current investment opportunities, and then obviously answer any questions you might have. Our chat is now open. If you have any questions, feel free to ask that at any time. And one of our moderators will share the question with me, and then I will repeat the question as well as share it, as well as answer the question with the audience. So thanks for being here today. To be respectful of everyone's time, we're going to get started. My name is Scott Lurie. I founded F Street in 2009 with a focus on real estate and alternative investments, specifically focused in the real estate industry. I have had a passion for real estate since I first started flipping my first house in 2003, and really enjoy real estate and all of the benefits and income and residual income and tax benefits real estate offers, and super excited to share those opportunities with you today. So thanks for being here. If you, once again, have any questions at any time, feel free to just jump into the chat room and ask your question. A little bit about F Street. We focus on value-add real estate investment. We focus on alternative investments, and we only focus on those investments in the real estate category. When I first got started in real estate, and I was borrowing or using other people's money or OPM to start building our portfolio, the biggest core value for me was one is to be truthful and forthright with all of our investors and make sure I get them their money back plus the return in as quick as possible. And so I was able to build up a massive real estate portfolio using my friends and peers and other individuals' capital to then leverage that through bank debt to buy and acquire distressed assets that we value add improved, and then we were able to refinance to repay the investors. I was able to do that for several years. And then we finally got involved in several other verticals, which we're going to discuss today, which are multifamily, industrial, as well as lending. One of our token investment opportunities in our promissory note fund, I started the promissory note fund in 2009. And at the time, and still today, it was always intended to be really simple. The intention was that I was going to borrow money from people and we were going to pay them a 10% return. We were going to pay that return to you monthly, 1/12 of 10%. And if you ever needed your money back, you were going to let us know in 90 days and I was going to return you that money. And that was the thesis that came around in 2009 when I started our first lending business. And we started with $700,000. Today, we have almost $90 million in this fund. And so what does the fund do? The fund has one purpose. We borrow money from you and we lend it to other real estate investors. We lend money under what we describe as hard money. Our brand is thehardmoneyco.com. And we have several other URLs. Before it was thehardmoneyco.com, it was milwaukeehardmoney.com, and that has morphed into a regional brand under thehardmoneyco.com. We lend our money at the first lien position at 15% interest. So we borrow from you, the investor, at 10%. We charge the real estate investor 15%, and we cover the spread to keep our lights on and make a modest profit. So who are our customers? Who does the Hard Money Co deal with? Well, we deal with the people that are flipping houses. We deal with a lot of folks that are fixing flipping houses. That industry continues to boom. We typically receive about 3,000 applications a year. And last year, we closed 443 loans. All of our loans are secured. Our loans are secured by the first lien on the property. So we only write first mortgages, and in the event of a default, we foreclose and we would take back that property as an REO or a real estate owned property, and then we would dispose of it. Our loan is capped at 65% of the value, the future value of that property. And so that has allowed us over the last, since 2009, not to, in a given year, take a loss on our REOs. So we underwrite conservatively. We put the entrepreneurial spirit into the investor, and we give them the opportunity to make money. Our investors earn somewhere between $10,000 and $200,000 on flips. It's really fun to watch and rewarding to see them be profitable at the end of the day. And then our loans, our average loan is $156,000, and we currently have about 600 loans in our portfolio. So as the investor lending us the money at 10%, your investment is spread out over our entire portfolio of the 600 loans. So pretty simple how it works. We like to use a simple example. We'd like everyone to understand simply how it works. If you made a $120,000 investment, that's a 1-year minimum investment period with us. Your investments with F Street Investments for $120,000. We will pay you $1,000 a month, or 10%, which is $12,000 during the period of the year. We do distribute these funds on a monthly basis. And so you will receive a check, you'll receive an ACH at the end of each month for this $1,000. At the end of the year, you can expect a tax document, which is a 1099 INT, which is a tax document, which is a 1099 INT. And in the event that you want your capital returned after the 12-month period, it's a two-way 90-day call provision, which simply means you would write us a note saying we would like to redeem our funds of 90 days, and we will then return those to you in up to 90 days. It could be sooner. That will include during this period of time you continue to earn your interest. So $120,000 investment pays you $1,000 a month. You earn a 1099 INT form, tax form at the end of the year, and it's after the 1 year, it turns into a 90-day two-way call provision. A couple highlights about the promissory note fund. This is one of our token investments. I have investors that have originally started with $50,000 investment in this and have several $1 million. I have individuals who are looking to offset retirement or become retired, and they want to offset some of their income but not have their principal at risk. So they would provide us, if let's just say, for example, they have a $200,000 a year lifestyle, they would provide us with $2 million of investment, and we would provide them with $200,000 a year of annual income. The fund has been launched in 2009. I've been paying out returns every month since that period of time with never a hiccup or a default. We have a great business model. It works incredibly well. It works in good economies and bad economies. Our diversification across 600 loans is very important. We investors enjoy a solid return of 10%. Source from our borrowers' interest payments. We collect monthly interest from our borrowers, and we pay that out to our investors. All of our loans are secured by real estate. Every one of them is secured by the first lien on the real estate. And if you do have an IRA or any form of retirement account, if you choose to bring it into a self-directed format, which is through Entrust or any of the available IRA holders outstanding, self-directed custodians, we take a lot of money in the retirement fund accounts. Sure. Someone asked a question about our foreclosure rate. Our foreclosure rate last year was 2.47%. That means that we issued and took back on the REO 2.47%. Our default rate, which is another key metric, ranges between 6 and 12%, which is somebody that either is not current or hasn't made their payments. But of all of those aggregates of defaults or REOs, the total amount of properties that we actually take back is a little under 2.5% of real estate. So call it 20 some properties a year is what we take back in a cycle. Over the last 3 years of aggregation of the receivable or the mortgage receivable, as well as the default, we have been positive $400,000 on those dollars. The other question? Sure. I'm sorry about that. Thank you. Someone asked a little bit about the total size of the fund. The fund today is comprised of about $90 million. So we started with $700,000 in 2009. We have about $90 million today. And our average loan is about $150,000. Sure. Someone asked a great question. It's always hard to determine how for me to validate and prove our flawless payment record. We have ample investors that we use as references that can speak to the testimony of their ability to and their verification that they've received funds from us for that period of time. My first investor, who's my college roommate, is still an investor today, and he continues to get his checks every month. We do go through an audit through audited financials, as well as we make our third-party accounting firm available to answer any questions you have on the financials. If you did want to do a deep dive into the financials, we would ask for a non-disclosure agreement, but we do provide all of this information in our PPM, or offering memorandum, so you can get another deep dive. But I always find the biggest mechanism to validate is to speak to some of our investors. And we have a list of investors. Some of them are aware they're on the list, some are not, but they are all investors and they're happy to speak to you. Yeah, so the question is, who do we lend money to? We do not lend to any consumers. We only lend money to LLCs or corporations. So if you are an investor of ours, you would have to be a business. 95% of our businesses are limited liability companies. Under that limited liability company, we do require the members of the LLC to sign a personal guarantee. So in addition to all of the other assurances we have from our mortgage and our underwriting, we do get a personal guarantee from each member of that limited liability company or corporation. Great questions. Thanks for asking them. We're going to jump into a few of our development opportunities. We talked briefly about our promissory note program, which is a token investment program that I've been running since 2009. As a closing remark on the promissory note fund, if you have dormant cash or cash that's sitting and you're looking for a secure place to put it to earn 10%, and 10% year over year returns is a phenomenal return. The promissory note fund is a very, very unique business. It's unique because our investors are making a significant profit. We can charge 15% and we can pay 10%. And so it works incredibly well. It's been working since 2009 without ever a hiccup to it. And if you have dormant cash or are looking to replace some form of income, this is a phenomenal opportunity to do so. We're going to briefly touch on our development. So we do have a few verticals at F Street, lending being one of our verticals. We do have multifamily in ground up development, which is another vertical. And then we also have industrial development, ground up development, which is another vertical that we focus on. A little bit about our overview of who we are and what we have right now. In development, in our industrial, we've got about 1 million square feet of development underway right now. And that's equaling about $95 million of value. From our multifamily, we've got 831,000 square feet under development, and that's a total of $113 million in process right now. We've got proposals underneath it. Part of our business requires us to build our pipeline, which we're going to discuss. Pipelines can be this year's pipeline or even next year's pipeline, as entitlements and site curation and development sometimes takes much longer. Most of our developments have some form of a subsidy from a community, which also has a much longer runway in terms of process flow. Common council meetings, village hall meetings, etc. We've already completed under the multifamily 845 units, and we're working right now on releasing. So we'll have about 2 million square feet of industrial, that ground up new construction that's underway right now. That will be completed by the end of this year, 2024. So we're going to talk briefly about one of my favorite projects. We've been working on this project for I'm going to say 6 years, because we bought this site 6 years ago as a sale leaseback from a local company. We knew the site was going to be redeveloped as it was a trucking terminal in a residential neighborhood. And so we always knew that the city was incentivized to remove the trucking terminal from the neighborhood. And finally, the tenant decided to move as his business evolved from needing actual cross docking space to what is now just office space. So we're introducing F Street West Bend. It's 105 units of Class A market rate apartments. And for those of you that don't understand what that is, Class A is just, I would describe it as upper echelon apartments with amenities, and market rate just simply means that there are no subsidies or financial requirements or covenants related to who we can rent to. We're not getting any tax subsidies to rent to low-income housing. This is just a market rate. If you qualify under your own income or your family's income, you are eligible to rent an apartment. We are building garden-style apartments. We've got a 10 to 13-month construction window. We anticipate closing on this construction loan in February and breaking ground in March. We have a total equity raise of $11.3 million, and we currently have already raised $8 million. So we have $3 million of remaining dollars to invest from investors such as yourself, and thank you for your consideration. We are targeting a 17.35% projected LP IRR and an equity multiplier after 7 years equal to 2.6 times equity multiplier. So if you invested $100,000, you can expect $260,000 after year 7. We've projected all of this through various different models that are all available for your review in our offering. But there's some really interesting highlights I'd like to share with you about the West Bend transaction. West Bend has already invested so much money heavily in this downtown area to redevelop it. They have a beautiful Riverwalk, and they've just finished a massive renovation of the downtown infrastructure. So West Bend is fully invested, meaning the community is fully invested in this. We've got amenity-rich living. The apartments and immediate communities have state-of-the-art features. We have a pool, a community room, there are walking trails. The community that immediately surrounds us is a phenomenal amenity-rich community. And our garden-style apartments, which means that you have your own individual entrance into each apartment versus a corridor apartment, really provides for a much longer tenancy from each tenant and provides for a lot of opportunity for folks to want to continue to stay and renew and actually establish their home in one of our garden style apartments. Another really important factor is there's strong housing demand is in West Bend. It's showing right now based on our market study, for all of our developments, we rely on a third party to do a market study. In this case, Tracy Cross, which is an industry leader in market studies, has done a market study and shown that the housing demand is 300 plus units a year for the next 10 years. So people are moving to West Bend. The demand remains high, and we're adding 105 units to a very high demand market with a very low vacancy factor. And then the other part of it that's really great is it's really situated between two major corridors of freeway, 41 and 45 corridor freeway. So and allows you easy access to get to almost any part of southeastern Wisconsin. We talked a little bit about incentives. Incentives are really important for all of our deals. With construction prices increasing and demand, the economic demand burden shifting to tenant and developer, we really depend heavily on the incentives from the city of West Bend. In addition to that, as an investor, you receive significant tax benefits, which include cost segregation studies and forward advancing of depreciation, which can significantly help you as an investor. We did secure a government subsidy. We do have a PAYGO TIF. There's two types of TIFs. One's a PAYGO, which means that you pay as the city pays as you go, and the other one is a forward advancement. In this case, we have a TIF, which is a PAYGO TIF for 12 years that offsets our tax implications and tax obligations. So every property tax that normally would be paid on the property level is reimbursed to us at 95% from the city of West Bend. Diversification, we always like to speak to diversification and make sure that you as an investor consider various diversification opportunities. We do love real estate. We do think geographically it's important to diversify. Asset type is type to diversify. So this is a great opportunity to diversify into a multifamily real estate asset. In addition to it, we talk a little bit about appreciation. Appreciation is sometimes hard to put a monetary or an economic driver behind it, but we do believe as you build Class A and you're able to continue to be in a thriving economic community, that appreciation will occur through the process. Passive income, I call this money tree income. It's kind of an interesting thought, but passive income happens like this. If you invested 100 grand and I'm able to return that 100 grand to you after 3 or 5 years, you are, as an owner, as an equity owner, continue to be able to shake the money tree with a cash distribution every single year based on your original investment. And so I have an example which we just completed of our industrial building. If you put $100,000 invested into it, after 18 months, we were able to secure tenants and refinance it. You now earn $8,400 a year based on your $100,000 investment forever. So you now have zero investment. Your $100,000 that you already invested has been returned to you. Your preferred return has already been returned to you. And every year, because of your original investment, you get $8,400 of income. Those are money trees. Those are true plant, receive, and continue to earn off of that money tree. And obviously, real estate is an inflation hedge. A lot of you that are here tonight understand investment and diversification, and obviously inflation. We've been talking about inflation for the past 12 months. We've seen a significant rise in interest rates, and all of our products have cost a lot more money as inflation is a real value. The federal government has indicated we have it close to a 2% number, and let's hope we do so we can keep moving forward. Yeah, so at F Street, any investment you invest in is what's described as an SPE, or special purpose entity. You do not invest in a blanket fund. We do not have unilateral authority for any investments. Any investment you choose to invest in has an LLC. So in this case, if you chose to invest in F Street West Bend LLC, you would be investing in and only in the 105 units of multifamily. If you chose to invest in F Street Investments, you would be investing in the promissory note fund, and those dollars never mingle with any other investment other than for the sole purpose of writing mortgages. So we do not, there is never a time that is considered where we would have authority to make any type of investment. You choose your investment. Each investment is very specific and defined and created for that sole purpose. Excuse me. So a little bit about structure. We create these models to help you visualize and understand what it looks like to be an investor of ours. We have a $100,000 investment here as a sample, and that investment earns a preferred return of 8%. So what does a preferred return mean? In the waterfall under our operating agreement, a preferred return is a preference return that allows you as the investor to earn 8% on your money while outstanding. That comes before any other distributions would be made on behalf of the entity. So in the first year, as you can imagine, if we're just building the building, your investment of 8%, you're earning 8% is what's happening, is it's accruing. We don't have any means to repay. Over the next 12 months, so month 13 to 24, let's just say we're stabilizing the asset. So we don't have any cash to make any payments. While we're earning income, we're stabilizing the cash flow, the balance sheet. And so after year one, we owe you $108,000 on your investment. After year two, we owe you an additional $8,000 because we haven't paid you. So now, after year two, we owe you a total of $116,000. Now, in month 25, I'm starting to repay you. So I would first pay the $16,000 back to you. Excuse me. And while I'm doing that, the $100,000 continues to earn the 8% preferred return. Once we pay you back $50,000 of that due to a refinance in month 36, I refinance the project, I'm able to pull out money, I can pay you back 50% of your capital. I then pay you $50,000, and of that $50,000, the $50,000 is still earning the 8% until I can repay all of that. And so the plan is that over the next 36 months, I'm going to repay you every dollar you have until you have your $100,000 back, plus all of your preferred return. That's what gets us to right here, right? So here's what happens. 100% of the free cash flow goes to the Class A members until their capital contribution is returned in full. So all that means is that nobody else gets distribution. No Class B investors, only the capital, only the equity in our deals gets paid back their money, all of the money, 100% of the cash flow until you have all your money back. So if my cards are not aligned with you, they 100% are, meaning I don't make any money. I don't get any portion of the cash flow until you, the investor, have received 100% of your principal back plus 100% of your preferred return back that is being accruing or paying. And so that's a very unique structure because we want to be aligned with you and we want to get you your money back. That comes back from a core value that I had from 2003. When I was borrowing money, I wanted to get it back to everyone as fast as possible. So this allows for 8% preferred return. Then all of the free cash flow, 100% of the free cash flow is going back to the investor, so the investor gets their money back. Once that happens, then you continue to get, the investor, 60% of the free cash flow, and developer gets 40% of the free cash flow. Couple items to discuss. Construction should be completed, projected for Q1 of 2025 with rental income in Q4 of 2025. So that means completion and the stabilization of rental income in 2025. We plan to refinance in February of 2026, which with capital paid on and cash flow distributions. So in February of 2026, in 2 years from now, we plan to refinance. We want to get you all your money back, or as much as we could possibly get you back during that period of time. And then all of the free cash flow goes back to you, the investor, until we get your money back and your preferred return. That's F Street West Bend. Once again, I think it's really important to just reiterate that we are not a fund, meaning I, as the principal, does not have unilateral authority to make investments at our discretion. You, as the investor, control 100% of your destiny and what you want to invest in. We never commingle funds, and we never interact between entities. The entities are a standalone special purpose entity for the sole purpose of the business that has been described to you and you have signed up for. So you would only sign up for F Street West Bend, and if you sign up to invest in F Street West Bend, that's the only entity you would be investing in. Let's briefly talk about Coleman Yards. Coleman Yards is another deal in our pipeline right now. It's currently active on our website. We are currently raising funds. Coleman Yards is a partnership transaction between Jay Jeffers and F Street. It is an adaptive reuse project of an unbelievable, massive development in Rockford, Illinois. The intention here, it's urban renewal, so we have this massive warehouse that spans across a massive area called Coleman Yards. That was a massive facility that has been defunct for many, many years. And what happens with defunct properties or businesses that go out of business is they become blights. And this was a massive blight in Rockford, Illinois. And the flip, as you see, is to become an amenity-rich, city-backed finance project from the city of Rockford. Rockford is more incentivized than anybody to fix this project. And so they're the biggest supporters of Coleman Yard. Talking about Coleman, the entity Coleman One Investor LLC is what you'd be investing in. There'd be nothing else you'd be investing in but that, if you chose to invest in this. It's a strong market demand. Rockford has a 0.6 vacancy factor. That is so important to realize that these markets, which are, I think it's the 15th largest city in Illinois, is a massively high demand market for housing and has very much shortage. It's strategically located in Rockford near key employment sectors. There's massive employers in this area. The city, which we're going to talk on our next slide, gives us a very robust package of incentives. And we have diverse tenancies. We have multifamily units and commercial space. This is a true mixed-use development. The city's putting up countless of millions of dollars, very specific to the parking structure and infrastructure that's going into the site. Talk about incentives for a minute. There's a tax credit advantage. Obviously, state and federal tax credits reduce the risk. We have tons of credits, which we'll look on the next slide. We have environmental insurances. The previous extensive remediation by the city has allowed for this to happen. So the city has invested to clean up this site and make it completely viable for housing today. We did get municipal support, which I'm going to show you. We have a $30 million incentive from the city. $30 million is a lot of money. And then we were able to get attractive financing through what they call a PACE loan. And PACE loans are legislative financing opportunities that are really helping our industry, the real estate industry, in the states that legislatively they've been allowed to come to reality. So we talked a little bit about the capital stack here, historic tax credit, grants. Look at this monster right here. This is a monster. But let's talk about it at a very high level. You have $106 million of total development going into Coleman Yards. So $106 million. You have $30 million coming from the municipal grant program. And if we read that right, it's grants, meaning these are not obligations to be repaid. They're just grants. We do have an historic tax credit equity of $29 million. We have a developer TIF of $10 million, and there's a developer fee of $7.5 million, which gets brought back into the project. The reason that the developer fee is there, just so everyone understands, is that if the larger we can bring up the numbers, the more incentives we are entitled to. So we put the developer fee into the transaction to allow the number to get bigger, but then we credit it back into the transaction. So think about this. Of a total of $106 million, we have one construction loan of $111.5 million. We have a PACE loan of $10.3 million, and we're raising $8 million of equity. That is all this project, all 215 units of this project owes is $30 million. So we're building something for $106 million, and we only are obligated to repay $30 million. $8 million to investors, $10 million to PACE, and $11 million to the construction loan. That is the power of incentives and subsidies. We talked a little bit about pipeline. I'd like to share with you a few slides of what we're working on at F Street right now for projects that are forthcoming. At Lakeshore Commons, we're just completing this building right here. As you can see, there's two buildings right here. We plan to start sometime in middle of this year. The next 132 units, which is Summit and Grove, they'll be going right here. Right here is the clubhouse amenity for the project, which is almost done. But this is under construction right now, and we actually have in this building right now 55 of 88 units already rented. We're renting about 17 units a month. The demand for housing in Oak Creek is phenomenal. Please take a look at oclakeshore.com. You'll learn a lot more about this project. There's also more information on our website about it. It's just forthcoming in the pipeline of what we're working on. We're working on a really fun project in La Crosse, Wisconsin, River Point District. We're talking about 164 units. Here's our site that we're working on in La Crosse. It abuts to a mixed-use development and multifamily development. There's housing, there's office components, there's parking structures, there's eateries. La Crosse is really putting their foot in the ground here with a very Class A development, and we're super excited to be in pre-development right now on this development. We're working on Brown Deer Garden Style in Brown Deer, Wisconsin. We just completed last year, Greenlink Apartments, which are 98% occupied in Brown Deer, Wisconsin. We have since acquired this parcel. We already own it, and we're in pre-development. This site right now is going to be a retail pad. We have LOIs out, believe it or not, from 3 different retailers. They're all fast casual or coffee concept right now, but we have unbelievable demand here. And then we plan on building the remaining garden style apartments behind it. Amenity rich. ample parking. Really excited. The village of Brown Deer is phenomenal to work with, and they've been a really great advocate of ours. So we're excited to build this development. And then one of our last ones is our Janesville development. We are in pre-development. We have site control of this site. We're pre-development to build 125 units in Janesville, Wisconsin. Demand in these markets continue to be strong, and incentives remain strong as well. So a little bit about F Street in our process. We've invested a lot of time and energy in technology. Thank you for finding us and being with us tonight. I encourage you all to go to fstreet.com, and you can effortlessly browse all of our offerings. You can also sign up for an account. The account is absolutely free. There's no obligations to invest. There's no obligations to do anything other than you can be in touch with us. We will be respectful of your email, and we will certainly share with you updates on who we are at F Street. If you do choose to invest with us, we do have a phenomenal portal for investors that shows all of their distributions, all of your K-1s, all of your operating agreements, and your monthly distributions. You get notices through the portal, and all of that information is housed in there. It shows you all of your assets. It's fun to watch some of our investors that have been investing with us for years and how much they have invested in their phenomenal diversification in our portfolio. So really great to have. Earn your badge. One of the things you can do at fstreet.com is get accredited. All of our investments are under the 506C distinction with the SEC. And what that simply means is that the SEC requires us, because we generally solicit through the internet to attract and retain investors, that you have to be accredited through a third party. So this process, for some people, is incredibly seamless, and for some people it takes a little bit of time, but it's free. I encourage you all to do it. Once you're accredited, your accreditation lasts for 5 years. The accreditation process, for those of you that do not know what it is, it requires you as a family, an individual, to earn $200,000 a year, as a family to earn $300,000, and or have a net worth of $1 million. We provide you with a letter, sample letter you can provide to your accountant or attorney who can attest to either of those statements. You can upload those with a few other simple documents, and you earn the accreditation. Today, we had 5 people get accredited. It was a great day. 5 new investors have gone through the accreditation process. They paid nothing. They have their badge, and they're accredited today for the next 5 years to make any investments in what we're doing. It's a simple process. It's free, as I've said, and I encourage you just to sign up at fstreet.com and be part of what we're doing. You have no obligation to invest, but you do get the ability to have the knowledge of investing. And so let's invest together. Once again, my name is Scott Lurie. I'm the founder at F Street. I'm very grateful for your time. I'm grateful for your consideration of your investment with us. Your investment dollars mean the world to us. We are respectful. We are extremely confident in who we are, and we take your investment dollars as if they're our own. We never lose sight of that. I would open it up for any additional questions anyone might have. If not, certainly want to thank you all for being here, and I hope to find you at fstreet.com, or you can always reach me at any time. The minimum typical investment for each project is $50,000. We do have some that throttle from 50 to 100, but most of the time the minimum investment is $50,000. My first investor invested $50,000 with me, and today has about $3 million in our promissory note fund. I never turn away the investor, because you never know who you're talking to. 1, you never know their current needs and demands on life change. 2, and we know how hard it is to find and earn enough money to put away dollars to invest. And when you do that, we are incredibly respectful of that process. We know that these are hard-earned dollars, and I want you to understand that every dollar you choose to invest with F Street is valuable to us, and we will do everything we can to give you the highest rate of return, and we fight for every dollar we can back to you. So right now the term length is set up at 12 months. After that, you have a 90-day call provision. I'm sorry, the promissory note. 12 months. If you want your money back at the 12-month mark, on the 9th month, you would say, Scott, I'd like my money back, and we'll return it to you. We always pay 10%. We don't pay 8%, and tomorrow we're not going to pay 9%. We pay 10%. 10% is super easy to understand. It's a great return in today's market and in any market since 2009, and it's a phenomenal return. We had to set a benchmark of 12 months for a term. With that said, we have tons of liquidity in and out of our fund. And while people do make the investment with the pre-notion of 12 months, we will, if you need your money back sooner than that, if you wrote us a note, an email, called me, Scott, can you please return my $50,000 or $100,000? I need it back after 4 months. I'll return it to you. I can't write that in a document legally because I do need to have a benchmark for what we would do in the event that the worst case scenario or the longest period of time has to happen. So I did establish a 12-month hold period, but understand if you needed it sooner, I would absolutely do everything I can to get it back to you faster. So the first question is, under the promissory note fund, have we ever gone after someone's personal assets? The answer is yes. It's a fundamental issue at the end of the day. If someone's going to borrow money from us, I'd like them to repay. And so we look at always under underwriting the ability to repay. We do, from time to time, get into very unique situations where you have people that become deceitful. They have assets. They're trying to protect them. They're moving around. I would tell you that it's a very low threshold. We're probably of the, 100 lawsuits we've ever been in, we probably are after 1 or 2 people on a personal level. That's about it. We don't do it as a business practice. If I can get out of the loan because someone's in default and they couldn't figure it out, okay, it's stuff. The world changes, but at the end of the day, I'm always trying to be a good person and do what's right for my investors. And if that requires me to go out and go after someone, I'll do so, but it's not something we look forward to doing. The second part of that question is, do we have any aspirations to become a REIT, or would we become a REIT? We don't currently have any aspirations to do that today. We have always been an alternative investment for the people. That's why we're here talking to the people today. We've always are for the investors. I've got hundreds of investors that have come from my mother and my sisters to my brother-in-laws to their neighbors. So we have investors that come from all walks of life. It's always great to be part of what we do. We don't view ourselves as an institution or being institutionalized. So we don't have aspirations today to be a REIT, but I don't want to ever block out an opportunity that could be beneficial to our company and our investors in the future. The question is, have we ever taken a loss on our REO properties? The answer is yes, but we don't do it as a practice. So to answer that with a little more definition, when we take back a property, from time to time, we have lost money on those properties. We've lost various degrees of $3,000 to $10,000 to $25,000. The aggregate, though, which is the most important, is if you took last year, for example, we earned $202,000 on the aggregate. That includes the losses and the gains. The net outcome was a positive $202,000. And over the last 3 years, the net gain has been $404,000. So we do take losses. I don't like to. It's not something that we enjoy doing as a business, but it does happen from time to time. We try to limit those to the least amount of opportunities or times that those will happen. And we do make profits on them. Over the last 5 years, we have not lost in a given year, but we have taken some losses during that period of time. So the question is, how do people invest? You can invest as an individual, as an LLC, as a trust, as a self-directed IRA, 401k. We take all walks of life. We do have people that invest most commonly in their individual name. We do have several high net worth families that invest as a trust. But we do have people along all different spectrums of there. We've got investment clubs that invest as an LLC. And we do see a rising amount of people that are frustrated with the equities market or the mutual fund markets, and they're taking their IRAs and they're turning those into self-directed IRAs and are making investments with us. So we take any type of investor under any asset category that you choose to establish for yourself? So the federal credits that are there, they're already sold, those tax credits that turn into monetization on that project. So the credits are not available on Rockford for individual acquisition. They are sold into the markets to help fund the project, and then they burn off over their period of time of abatements, traditionally 7 years. All right. Last call for questions. These are great questions. I appreciate the engagement tonight. Does anyone have one lasting question or one question that you didn't get to ask? I'd love the opportunity to answer it while I've got everyone on the line today. All right. In the event that we don't want to answer it on this forum, I'm going to hang around for a few minutes. If you do have a question, simply type it in the chat and I'll come back on and answer it for you. Once again, my name is Scott Lurie. I'm available on Instagram at Hard Money Scott as our handle. You can also find us at fstreet.com, and my email is scott@fstreet.com. Feel free to email me if you have any questions or want to further discuss it. I really value your time. I appreciate you joining us this evening. We're in Milwaukee, Wisconsin. It's -3 degrees. So wishing everyone a warmer winter than we're experiencing right now. If you need anything from us at F Street, I'm always available. Thanks for joining us, and we're going to hang around for a few minutes for some questions. Otherwise, thank you again for being part of and considering investing with F Street. Thanks for the last question we just got. Someone asked, what's our general payout per $100,000 invested in one of our development projects? I typically use a sliding scale. Our best result so far has been the 8,400 in Appleton, which is now $8,400 after 18-month hold period and your money back. I'd like to use a scenario somewhere between 3,000 and 8,400. A lot of that depends on several characteristics as it relates to our end financing. If interest rates should drop another 100 basis points and we seek end financing, that should increase the number closer to 5,000. Depending on the credit and the rent we're able to obtain in some of these investments, that impacts it as well. In the developments such as our multifamily, F Street West Bend, I would be comfortable in the $4,000 to $5,000 range, specifically because our exit's going to be a HUD loan, and we plan on exiting that in a long-term category with HUD. We see a competitive market there on a going forward basis. So That's my estimate, but once again, these are estimates. I appreciate you acknowledging that they're estimates, and we will continue to fight for every dollar to get to the best outcome for you. Yeah, and that's thank you. And that is an annual return. Once you have 100% of your capital return, that doesn't account for any reduction in principal on our mortgage, and it doesn't account for any appreciation. So if you go to the return mechanism where we forecasted a 2.6x multiplier, you can, for $100,000, anticipate when we sell the asset in 7 years, getting a total return of $260,000 over that lifespan of 7 years. Great question. Thank you.